But if you look at what the future returns are going to be for you personally, I think you won't overlook so many deals. But if you understand the cash flows and the income that the property is going to make you in the future, you might be able to pay a different price than somebody else that's looking at the current cap rate today, which I've seen a lot. And then one of my single family homes had about $100,000 of equity that I had paid down. What I did to pay that one down is called velocity banking. So I had about $170,000 mortgage on the property. And what I would do is I took a line of credit and then I started paying down my house until I got to about, I think it was $90,000 of principal left to pay. And what I did is I recasted the mortgage. What that recast does is it stretches the mortgage back out over the term of the loan, like as if you were to pay it out over the full course of the loan. So that means that if I would have not recasted it, I would have had like 15 years left to the loan. But instead, since I paid it down so aggressively, I could stretch it right back out, and I got it to 29 years. And my monthly mortgage was $500 a month. And that was the thing that actually helped me move into my next primary house. But then once I did that, I was constantly seeking ways to access the capital, whether I get a line of credit on it, a bigger line of credit, or do I go back to the bank and give them all my financials to get a better refinance? And I actually had to do that. So I went and refinanced the property, pulled out $50,000. And after I've already paid it off, and within like 6 months of doing that, the appreciation went up a little bit more. And then I decided I'm just going to sell the property. And selling the property gave me about $100,000 in my bank account. And now I have this 3-unit and a 9-unit mobile home park. It's paying all my overhead. So I'm technically financially independent at that point. I don't know if it's financially free, but it covered all my overhead.